What is Williams percent range? And by the end of this session, you should be able to understand what is Williams percent range, how to add it to chart, interpret and use the indicator. The Williams percent range, or Williams percent R for short, is a popular momentum indicator used by traders to find entry and exit point for their position. The indicator was developed by well-respected trader Larry R. Williams. The Williams percent R indicator is part of the oscillator family of technical indicator and is similar to the fast stochastic oscillator, but the only difference between the two is how the indicators are scaled. The stochastic indicator oscillates over time within a band between the 0 and 100 level, while the Williams percent R indicator oscillates over time within a band between the -100 level to 0 level. Let's look at the formula. The first step is to decide on the number of periods to be included in the calculation. Calculate percentage R by comparing the latest closing price to the range traded over the last X number of periods. By default, the Williams percent range is calculated based on period 14, but traders can change this according to their preferences. Let's look at the features of this indicator and how to interpret it. This indicator has fixed range between the -100 and 0, and the Williams percent R cannot exceed 0 level and cannot fall below -100 level. This indicator automatically plots two more levels to indicate when the market reaches the overbought and oversold level. The extra two levels can be customized according to traders' preferences, but in general, above -20 level will be the overbought and below -80 level will be the oversold. We'll go through the Williams percentage R indicator trading technique in details on chart and also how to use it with combination with other technical indicator. Let's begin with placing the Williams percentage R indicator on chart. To place the Williams percentage R indicator on chart, there is a few methods to do it. The first method is go to Insert, then Indicators. Under the oscillator, select the Williams percentage range. The second method will be the easiest one, as you click and drop it from the navigator panel. To do that, simply go to the navigator panel, Indicators. Under the oscillator, click the Williams percent range, drag and drop it on chart. Now let's look how to use the Williams percent range indicator in trading. There are three methods in which traders can use Williams percent range indicator during trading. They are identifying the overbought and oversold. Second, identifying the divergence between the Williams percent range indicator and the market. Third, using the Williams percent range in combination with a trend indicator. Let's look one by one in details how to use them. Overbought and oversold. The most common Williams percent range trading strategy is to look for overbought and oversold extremes. This means that traders focus only on long position when the Williams percent range indicator falls below the -80 level, and focus only on short position when Williams percent range indicator rises above -20 level. The logic behind this strategy is that when the market rallies too much, it's more likely to make a pullback. On the other hand, if the market falls too much, it is more likely to make a bounce. This method can be used only when the market is in sideways, but not during trending. Just because the market has rallied too much and is overbought, it doesn't mean that the market must reverse. And when the market has fallen too much and is oversold, doesn't mean that the market must rise. Let's look at this example. Market continuing to rally despite the Williams percent range indicator indicating that the market is overbought. Bullish and bearish divergence. Mostly traders use divergence to predict tops and bottoms in the market. A bearish divergence happens when the market making higher high, but the Williams percent range indicator makes lower high. This indicates that the market is overextended. The rising power is minimal and signals the market may fall soon. A bullish divergence happens when the market making lower low, but the Williams percent range indicator makes higher low. This indicates that the market is oversold and the decline may be slowing down and signals the market may rise soon. Here are few examples of Williams percent range divergence signals. Combination with other indicator. The final method is to use this indicator in combination with other indicators that define the market's trend. So how do we define the market's trend? There are many ways, but one of the easiest and most common ways is to simply look at the market's 200 moving average. This means that traders should only focus on going long when the market is above the 200 moving average, and the long position can be taken when the Williams percent range indicator crosses above the minus 80 level from below. Similarly, traders should only focus on going short when the market is below the 200 moving average, and the short position can be taken when the Williams percent range indicator crosses below the minus 20 level from above. Here are few trade examples that use the Williams percent range indicator in combination with moving average.